Hi, in this video we're looking at another source of risk within financial assets, and in this video we're going to be looking at political risk. So what is political risk? Well, it is the risk of investments falling in value due to instability or political changes in a country. And we're going to sort of have a look at some examples, and I've split these between instability and political changes just because that's what our definition is sort of broken down into. But these two, instability and political changes, they are strongly related. So the examples we're going to look at are sort of applicable to both sections. But the point is that assets may fall in value due to there being instability within an economy, and that instability can lead to political changes, so changes in policy, which may negatively affect the value of investments. But remember that we're talking about risk here, so these things may not necessarily happen, but we're looking at how likely it is that they will happen in the future, and so our asset values will be negatively affected. We have some sort of risk premium that we have to pay because in the future there is the possibility that these asset values are going to fall in price due to instability or political changes. So what do we mean when we say instability within an economy or instability that is related to an asset? Well, we could see wars. So for example, we've seen conflicts in the Middle East where assets may be seized or destroyed during a conflict, and this will obviously make them worthless, so the underlying value that we see on, say, a stock market will be negatively affected. And we mentioned the Middle East, but the fact is, say, economies like the US are also involved in wars, but we wouldn't necessarily see this factored into US asset values as much, because even though the US is, say, involved in wars within the Middle East, in the past we've seen, say, the Korean War, the Vietnamese War, these don't necessarily have the possibility of large political changes within the USA. They're more likely to have an impact on, say, the Korean economy, the Vietnamese economy, economies within the Middle East. So even though the US may be involved in wars, their asset values would not be as affected because we wouldn't necessarily be seeing US assets being seized or destroyed during these conflicts because they're not on US soil. Similarly, terrorism, we could see assets being destroyed, or generally this would negatively affect asset values because we are seeing instability within an economy. And just generally, civil unrest, we could see that there's a change in regime or government because of this civil unrest. We could see, say, coups where the army seizes control of a country, and mass protests may make it appear more likely for investors that there's going to be a change in government, or at least a change in policy. And that will move us on to political changes, where we could see either a change in government due to, say, there being civil unrest and this government being overthrown, or we could simply see, say, protests within an economy or any reason why the existing government decides that it wants to change its policy. So, for example, we could see changes to taxes and regulations. So these may affect specific companies as they have to pay higher taxes, for example, corporation tax, or there could be new regulations which are going to lead to lower profits. And these may be minor changes in policy or major changes in policy, but the point is that if a government is perhaps more unstable, it may be seen as being more likely to make changes to policies, and changes to policies tend to be viewed negatively by investors. Say, there could be a change in regulation which massively helps certain businesses and thus will increase asset values, but if there is a risk of change, investors will tend to be cautious and require a larger risk premium, and thus asset values will fall if there is a risk of changes to taxes and regulations. We could also see changes that occur in business laws or investment regulations. So these may prevent certain investments or add red tape to certain processes. So for example, if there is a new government which is really opposed to foreign investment, then this will be very bad for foreign investors because they may not even be able to invest in certain assets. They may have to sell their assets in future, which will obviously make the value of those assets today lower if there is the risk that in the future they may have to sell them. We could also see changes in foreign trade policies, such as tariffs and trade embargos. So, for example, we saw a trade war quite recently between China and the USA, which saw tariffs being put in place on a lot of products. This can have a huge impact on a lot of assets, as these two economies are responsible for so much of the world economy. We may also see currency controls. So this would potentially involve limitations on buying and selling certain currencies in order to stabilize the exchange rate. We see floating exchange rates in a lot of major economies today. So we can see that the pound changes in value against the dollar and the euro over time, but a government may decide that it's not going to let you buy and sell certain currencies, which means that your exchange rate is going to be, say, pegged to a certain other currency. So you may peg your exchange rate to the dollar and say, you know what, my currency is going to be worth 50 cents or something, and the government is going to restrict that. And that's obviously going to change your returns. If you are, say, based in the USA and you have invested in a foreign asset, your returns are going to be affected by how that government decides to control its currency. So there's another risk here. We can also see sovereign credit ratings changing. So this is an assessment of the credit worthiness of a country. So if the country's credit rating was, say, downgraded, that government would be seen as having a higher risk of defaulting on its loan. So it would be more likely to not pay back its debts. So any assets that are backed by this government will be less valuable. And a sovereign credit rating can change for any reason. You may still have the same government in place, but they have just consistently not paid back their debt, so their credit rating is reduced. We could also see if there is a new government that has overthrown the previous one, and this government may not be recognized by the relevant international authorities, and so they are viewed as riskier. You don't really want to borrow money from or have this government owe you money because they are seen as less reliable, especially if they're not even recognized as a government. Their credit rating will be much lower. And the final one is that we could see sanctions against an economy. So, for example, if a specific country has breached international trade or humanitarian laws, there can be tough financial penalties which negatively affect the asset values within this economy. So an obvious one, which people may have studied at, say, GCSE level within history, would be Germany after the First World War, where they had to pay back lots of money in reparations, as well as various other sanctions put against the economy. But the point here is that if we have a country that is viewed negatively by the international community, there may be sanctions put against them, and so there is a risk that there are going to be negative effects of that, because the international community, say, puts trade embargoes on them, puts fines, and so on, which are going to negatively affect the value of assets. So investors may avoid assets that are exposed to that economy and to that political risk within that economy. So that was a quick introduction to political risk. If you found it useful, please do drop a like rating. Make sure to check out the other videos on the different kinds of risks within financial assets, and subscribe to add some econ to your subscription feed.